Hey everyone, me Kevin here. You know that I watch the housing industry like a hawk. That's because 70% of my investments are in real estate with about 30% in stocks. And two big changes just occurred that are worth paying attention to. If you're an OG member of this channel, you already know that I love looking for inflection points, changes in something that's happening to where we could use those changes to know what else might happen in the future. That beats just reading the headlines about what happened last month. I don't really care about what happened last month. Last month, the Realtor Association said that existing home sales went up 24.7%. Last month, we saw that home prices went up 8.57% between July 2019 and July 2020. But neither of those booming statistics reported by the Realtor Association are what I'm paying attention to today. I'm paying attention to the things that don't always make the headlines. So let's talk about these two things, but the first thing I'd like to do is introduce the sponsors. Get life insurance in as little as 5 minutes via the link down below, and of course, if you deposit $100 with Webull using the link below, you will get 2 free stocks in return. You could sell those stocks if you want, do whatever you want with them, but the second stock might be worth up to $1,400. Okay, let's get into the changes, and I'm going to simplify this as much as possible to keep this concise. This applies to both single family and multifamily. Over the past several years, the share of homes that have been sold to investors has usually been about 9%. So when 100 properties sell, 9 go to investors, 91 go to people buying homes and actually living in them. Just for comparison, in the multifamily space, like 2 units, 3 units, and 4 units, you're usually about 50-50. So you get a lot more investor competition. Something that's very interesting though that happens is as prices go up and real estate becomes less of a deal, knowing that investors always want a deal, right? I mean, that's why I have a real estate investing course, 0 to Millionaire. I teach you how to look for deals, whether you're a home buyer or an investor. You should always think like an investor. Very, very important. But anyway, the more investors you have, generally, the more of a sign you have that there are good opportunities right now. When you have less investors, it's usually when you see that prices are going up and investors start leaving the market because they just throw their hands up and say, there's no deal to be had right now. I'll just wait for another good deal. And that's consistently what we've seen between really 2016 and 2019 is a smaller share of investors. It's been harder to get deals. Now that doesn't mean it's impossible to get deals, but between 2016 and 19, we've seen about that 9% investor share. Well, here's the first big change. In July, we had the biggest shift that I've personally seen since 2011. We are now at 15% of people buying homes who are investors. That's almost double what we've seen. And again, I haven't seen numbers like that since 2011 at the bottom of the market when I got started trying to compete against investors. When the investors and the bottom feeders are out, usually it's a good sign that it might be a possible buying opportunity relative to other opportunities. That's something to always keep in mind, the last thing I said about investors. Investors usually aren't just looking at, all right, I'm only buying real estate. They're usually doing, oh, what's that over there? Oh, stock market doing well, I'll put some money into that. Oh, bond market doing well, I'll put some money into that. But when the stock market's like crazy the way it is now and tech is through the roof, bonds are boring because the yields suck right now, you kind of look at real estate and there's no surprise that a lot more investors are going, oh my gosh, interest rates this low, cash flows look better, I could refinance, I'm gonna go buy more, I just got a PPP loan, I just got more stimulus money, I'm gonna go shopping for some real estate. And now we've seen an almost doubling in the amount of investors closing on homes in July. This is bad for home buyers or people who didn't have a lot of money before the pandemic. Think about that. If you didn't have a lot of money before the pandemic, you probably still don't have a lot of money. If you had money before the pandemic, you probably got a lot more money because you were able to sort of ride the PPP wave and the stock market wave and the rebounds that we've seen, the low interest rates. It's crazy. It's sort of the spreading of the wealth gap is what this pandemic has done. But what are the bottom line signals that we've seen an almost doubling in the amount of investors closing on single family homes? Well, the bottom line is there's more enthusiasm by bottom feeders in the real estate market right now, which is generally a sign that no, we're not necessarily bubbling, but yes, we're seeing value again. That's good. As soon as that value goes away and we start flipping out of these investing deals and we start seeing more home buyers saying, I just want to get in, I just want to get in, I just want to get in, that's when we start seeing that bubbling. When we have this high share of investors who are potentially just trying to protect themselves with 30-year fixed rate loans and protect themselves against inflation, I think we're in a good place to consider buying now. Now, I'm going to have some warnings about whether you should buy or shouldn't buy and some possible downward pressures coming at the end of this video. So if you think the market's going to blow up and explode, we're going to talk about that in just a moment, and it's totally fair to be concerned about that. But this inflection is definitely something to pay attention to. We want to keep an eye on that rate because it's gone significantly higher than what we've seen in the last few years. And with how stringent lending is today, it's a good sign that people are coming into real estate because they see value and that you've got people getting high quality loans who are getting into these deals. Okay, the second shift that we've seen now is a delinquency shift. In July, we saw a 20% increase in the amount of properties seriously delinquent. Now, usually I don't pay attention to this because obviously we know mortgage forbearance exists. I recommend you take mortgage forbearance. I did shift my original stance on that, and I have an entire video explaining that. I'll link that down below. You can also go to metkevin.com/forbearance and get details on that. It gives you all the scams and the tricks banks are trying to pull over on people. It's totally messy. But usually I don't mind the delinquency figure because of the forbearance. But now that we're seeing a 20% increase, it's absolutely something that we should be paying attention to. I don't know how much of that 20% increase we can really attribute to sort of this second wave, which isn't really a second wave of COVID. It's just sort of like, you know, we went up, then we went down, and then we're up again. Like, I don't know how much we can attribute to that or how much we can attribute to actual job losses. It's tough to tell with forbearance. It's something to keep an eye on, but that's definitely an acceleration compared to what we've been used to. So pay attention to that. A 20% increase in delinquencies is going to be something we'll want to keep an eye on. Remember, people can get up to 12 months of forbearance. The first month most people really started getting forbearance was around May. So we're probably going to want to keep an eye on this for the rest of this year. And then come January, February of next year, we're going to start running down the clock of how much time people have left on forbearance. Now, a lot of people in forbearance, not everyone, stupid banks, are able to put the balances they owe at their end of the loan, which is good. That'll help us prevent a foreclosure crisis. But when it comes to tenants, tenants don't have that luxury. We've talked about this a lot. But if the Senate fails to pass some kind of decent unemployment boost, which so far they have, and they don't pass any kind of decent rental assistance and eviction protections, we're more likely to see more evictions, and that could lead to a decline in prices, or at least a slowing in prices. Will it be enough to cause a foreclosure crisis? I don't know yet. Personally, based on some of the last research that I've done in other videos on this topic, I don't think so. But we will have to pay attention to it, because if we see delinquencies combined with evictions, combined with interest rates going up, that's when we're going to really see big problems. So keep an eye on that. Now let's talk about some warnings if you are possibly considering buying and you're worried about the market potentially going down. Number one warning: avoid move-in ready turnkey real estate. Be cautious about what you're buying. Be like an investor. Think like the people in the real estate investing course do. The way they think is, how can I buy a deal and instantly increase my net worth? That is going to insulate you. It's going to make it easier to get rid of mortgage insurance. It's going to protect you. Think like an investor, act like an investor, buy like an investor. Next, if you already own real estate, I would caution against getting refinance happy. It's totally fine to drop your interest rate, but be careful doing all the cash out refinances unless you have a place to put the money. That is, I wouldn't recommend going YOLO into Tesla call options or SPY puts because we just don't know what's going to happen in the short term, and I don't want to see you wash away your long-term hedge on a speculative bet. So don't go too heavy on the cash out refinance. Maybe it's not the right time to buy a brand new shiny Tesla and to buy an RV, even though we kind of all want to do that. It's probably better to be a little bit conservative. Remember, when we were in, March, April, May, June, hey, those were some good buy times for real estate. We haven't seen the prices tick up yet. Now that we're really starting to see the prices tick up, you really want to sort of refine even more and make sure you're especially getting a good deal in real estate now. If you are going to buy something move-in ready, stick to new construction. Usually I don't like new construction. You pay a little bit more than market value, but stay away from turnkey real estate and flips. Seriously, whatever you do. Okay, number 3, limit negative cash flow. And now this is a big one. If you're out there buying right now and you're like, Kevin, I can only put 5% down, but I've got a really good deal. It's one thing if you're getting a really good deal, but be careful you're not floating too big of a negative cash flow if your job is uncertain. Personally, I try to recommend that everybody just stays away from negative cash flow. Sometimes on your first property, if you're gonna move into it and you're paying a little bit more than what you could rent the property out for, hey, that's the cost of doing business. Hopefully you got a really good deal on it. But try to minimize that. That is, if you already own real estate, try to start limiting your negative cash flows, pay off a little bit, do, recast your mortgage if you can to lower your payments, get a lower interest rate to try to get back into that cash flow territory, get your tenants, give them a 1% rent bump. I know tenants don't like to hear that, but the reality is you should be bumping the rent every single year, even if it's just a little bit. You know what? Here's 0.5%. Even now, during the pandemic, I just want everybody to be as protected as possible. So keep in mind the things we talked about in this video. 2 big inflection points we got to pay attention to. Number 1, almost a doubling of the amount of investors buying single family. That is impressive. It is a very good sign. It's a bullish sign. It's a sign that maybe now is the time to buy. Number 2, keep an eye, though, on delinquencies, which delinquencies will be more of an issue around May of 2021. Pay attention to that, along with Congress, unemployment and eviction, and rental protections and rental assistance. And the big warnings, buy good deals. That's the best thing I could recommend right now is learn how to get a good deal. Get a deal below market value. Don't pay market value for something. If you're looking at a duplex because you want a house hack, don't overpay for a duplex because you want a house hack just because you want to get in. Dangerous. Just be careful if you're doing that. That's generally the recommendation. So folks, there you have a real estate update for you. And hopefully you appreciated this. If you like this kind of content, make sure to subscribe. And folks, we will see you in the next video.